Thank you. Happy to see so many of you here, and hopefully you can ask questions as we go along. Generally, these things are done where we present and you ask questions at the end. But we're going to go through quite a lot of material, so feel free to interrupt at any time. What I'm going to do initially is start with a few minutes on bank valuation, and then talk about the specific set of research that Professors Nassim Khan and I have done together. And in setting that up, in my time at Morgan Stanley working with research analysts, one of the first things I asked them was, what is one of the key factors that you have to look at with valuation for banks? Okay, and we'll get to that in a second. You'll see that it's the area that is in fact covered in this paper. So the first question are, how are banks typically valued? Anyone want to hazard an answer for that? So book value, market to book is one, and tangible book two. Anybody else? Yeah, but it's related to the return on equity. I mean, the book value is important, but it's also what you generate in terms of the book value, or the equity that you invested. And it could be tangible or combined. And this particular diagram actually comes from a very well-known analyst, actually at Morgan Stanley, but you can see it's very typical of what you see. There's some questions about whether this makes sense or not. That's a separate issue, but it's very typical of what people do, where if it's above the sort of, she hasn't got it as a straight line, but if it's above the line, it's perceived as overvalued. If it's under the line, it's perceived as undervalued. Okay, so that's very typical of what people do. So then the question that arises from that is, so what is, for a typical bank, the primary income generating assets, i.e. that are on the other side of the equity? And then how's the income generated, and what's the risk related to that profitability? Okay, so if we this again is more for background purposes. This is an example of a US bank, which is essentially just a commercial bank. And I'm giving you these time periods because it's in the transition from a crisis to so-called more normal times. And if you look at the assets, what you see is, and I'm using this also to define some terms that we're actually going to use in our analysis. So you see the context of when we put up some equations and things, you'll see how it all fits in. So what you see here is, if you look at this mix of the loans are the primary asset of most commercial banks. And you can see there's commercial and real estate and then other retail loans. And you'll notice that that's by far the largest set of assets. There's something underneath here called allowance for loan losses, okay, which is the issue of, are you actually going to collect on these particular loans? And the allowance we call ALL. Now, if you look at the way the accounting works in the United States, in particular at the moment, you'll see that the allowance for loan losses, this is the terms that are described in the actual financial statements. They talk about probable and estimable for what they call and what's generally known as incurred losses. So what that means is that you have to, under regulation, be able to justify it looking at what exists today, not necessarily what's going to happen in the future. Okay? It's what's going to happen in the future conditional on what you can see today. So if you believe that you've taken on a lot of risk, but you can't actually document that risk right now, you have a hard time justifying to the regulators and the auditors why you would actually take a loan loss provision against it. Okay? So if we look at the income generation piece of this, and feel free to interrupt me at any stage if you want, but if you look at the income generation, where's the income going to come from? Anybody? Right, the interest on the loans. So if we look at the income statement, you see again the primary interest income, which is most of the income, is from the loans. Okay, there's also some from securities and so on. But yet, when you look at, well, where's the risk and the uncertainty? Clearly, there's risk in the interest rates themselves, which is very topical at the moment. But the other part of it is related to the credit losses. And if you look at this time period, you can see, this is just coming out sort of at the latter stages of the credit crisis, you can see that the actual loan loss provision, the expense that goes through that income number for the ROE that relates to the valuation, is more than half of the actual net interest, of the interest income, let alone the net interest income, which takes what cost of that lending actually is. So this becomes a very important number, both from the asset side and the equity side, and even more importantly in some respects from the expense side. So if you're going to do valuation of banks, you have to have some handle on what these provisions are and what the expected losses for credit are. Now, I mentioned to you that when I came to Morgan Stanley and we were working with some bank analysts, and I asked them, well, what are one of the key drivers of value? The first thing they all come up with is, what's the expected credit losses? So the question really is, how do you estimate that? And that's the essence of what our paper is trying to do. One other piece of background information is, when loans are paying off interest and paying off principal, there's no problem in some sense. As soon as there's any concern with payment, they are treated as what's called non-performing loans or non-performing assets. So we have a set of information, this is all public information, about which of those loans have become non-performing at different points in time. So it's things like not paying interest for 90 days, or having some sort of restructuring, or troubled debt restructuring, or something like that. Okay? So if you look at that, you've got these non-performing loans, you've still got the allowance for loan losses, and then there's something called charge-offs. So what happens is, as soon as someone actually cannot pay, and you believe you're not going to be able to recover it, subject to any value you can get from any collateral you have, then you actually charge it off. So that's the realized credit losses. So you're providing for some expectation, but then what's actually the realized credit losses that are going to occur? And frankly, that's the one that's the most important at some level, because that's the one where you know you're not going to get the money, or more likely not to get the money. So how do you actually measure this? Well, it turns out when you talk and work with a lot of investors and analysts and companies themselves, it's an extremely tricky measure to come up with. Obviously, there's no certainty about it. And as I mentioned, the incurred loss issue makes it a little more problematic, because it allows managers, even without that, frankly, but it would allow managers to make judgments. There are a lot of judgments that have to get made, and people have to look at it. And you'll notice here it's about what happens in times of economic stress, because then it becomes even more problematic, and that's what Professor Khan is going to spend some time on in the next part of this presentation. So what we set out to do, and again I should emphasize in the context of what this program's about, that the starting point was around the valuation question in terms of doing bank valuation. So we developed a test really of, we developed a model of expected realized credit losses, or rate of credit losses, and we tested for that. The basic findings we have are that this measure we come up with does quite well, and certainly better than all the other public measures, in terms of forecasting or getting to predicting the future credit losses, or the next period's realized credit losses. And actually it does better than a fair value measure that banks come up with themselves, which should include their view of what those expected credit losses are. Okay, and so we believe that taking this approach would actually be quite useful in terms of anyone who wants to do a valuation approach. And actually the accounting is changing to be more forward-looking, so there may actually be more value in that. So let's get to why this particular approach is potentially more interesting. And I'm going to just give you a couple more anecdotes, and then I'll get into it. So the first thing is, this is a case study that Professor Khan and I actually put together for core accounting, although it's not used these days. And this is two local banks, Hudson City and New York Community Bank. So this is non-performing loans to total loans. And this is just as the crisis is starting. So the blue is the Hudson City and the red is New York Community Bank. And you can see here there's a big shift where the non-performing loans has gone up significantly for Hudson City Bank. If you look at the allowance for loan losses to non-performing loans, though, you see the opposite happening. So in fact, New York Community Bank is higher and going up, even though their non-performing loans aren't. So this is the first hint that there's a lot of judgment that takes place, and when you look over time, there's a lot of uncertainty around those measures. If you look at the allowance to total loans, they're sort of the same picture. So it's both at the full level and the non-performing level that you see these two banks with very different views, and they're essentially in the same business in the same region, although New York Community Bank has some nuance. If you then look at the charge-offs to the loans outstanding, again, there's a very fast rising pattern for Hudson City, but this is still at a high level, and until the last year was actually at a higher level. So the charge-offs were relatively high to the loans outstanding, but this is not really reflective of all of those. Okay, so what happened 1 year later? And one of the questions we would ask the students is, so how would you predict expected credit losses going forward, or any of these measures? If you go 1 year later, what you actually see is the non-performing loans have both risen at more or less the same rate, which again is indicative of these two banks being relatively similar in the underlying loan portfolio. When you look at the allowance, though, again, what's happened is that the Hudson City is going up a little bit. The New York Community Bank's actually going down. So while the problems are arising, the allowance is actually going down relative to total loans and to non-performing loans, whereas the net charge-offs are still rising. So the bottom line of all this is very hard to predict, and secondarily, management's playing a role in terms of the timing of when they're creating the allowances, the provisions, and then when we see the actual charge-offs going on. Okay. So again, this is why there's room for us to come up with something that's potentially more meaningful. Okay, so let me explain what we have here. What we're trying to do is come up with an expected rate of credit losses, or realized credit losses. And this is the realized rate in the prior period. So we would expect that the next period's expected rate of credit losses would be associated with the realized portion, plus non-performing loans relative to loans, the yield on loans, which clearly captures some of the expected credit risk itself. This is a measure of duration, really. And then we split between real estate, consumer, and others embedded in this term over here. Because consumer loans are very different to real estate loans in terms of their expected losses, in terms of how easy it is to measure expected rate of credit losses. The issue is, well, how do you measure this? And in a simple version of it is, you would expect realized credit losses to have some association with the expected losses, and if we could get it right, more or less, then it would just be random error around that over time. So that's sort of an assumption that we embed. Here's where it becomes sort of key in terms of what we're really doing. What we start off with, or one of the key parts of this is, we are looking for a change in non-performing loans, what's expected and what's unexpected. So you would expect, as loans go up or down, that would change the non-performing loans in the future periods, because the reality is, no matter how good you are at giving out money, some amount, or lending money, some amount of it is going to be go bad. Even the most conservative banks, unless you lend to nobody, you can't be certain about how it's going to work out. So what we do is, this is, in a sense, an expected growth or change in non-performing loans. When we see the actual relative to that, we're assuming that that's unexpected. The next thing we do is we estimate this realized, or we adjust the actual charge-offs for a portion of that unexpected non-performing loan. So the question is, once it becomes non-performing, how much of that is actually going to be realized as a credit loss? Just because it's non-performing doesn't mean it's actually going to be lost in the next period. Okay, so this is a critical piece of what we're actually using in our actual model or analysis. Okay, so what do we do with that is we're estimating essentially this and the other components in terms of how much the net charge-offs today, okay, so that's in some sense the dependent variable, how much of that is explained or associated with last year's charge-offs, this change in unexpected non-performing loans, the non-performing loans themselves, and these other factors. So we start off doing this, and I should just clarify for those of you who are thinking about this statistically, what we do is we're looking across all banks, or the banks in our sample, at each point in time. And we're trying to say, what is the average measure, if you like, for banks at that point in time? And then we look across time for each bank. Okay, so the essence of it is we're trying to capture something that is less biased in terms of each bank manager doing what they're doing, because there might be some structural changes that are occurring across time. Okay, so let me give you an intuition of the first set of results. Firstly, what's important is that you'll see that this measure that we essentially came up with is statistically significant. And if you look at this combined period, you'll see what it basically says is around 17 cents or 17% of all this change in unexpected loans, non-performing loans, actually turns out to be charged off. Now, if you think about the credit crisis, real estate loans in general are less likely to require charge-offs because you have a lot of collateral behind them. And if you give a loan, you tend to have a loan-to-value ratio that's 80% or below. Okay? So in normal times and prior to the crisis, there's actually very little association between the real estate loan portfolio and net charge-offs. But what happens during the crisis is all of that fell apart. So it's actually comforting that we've got some real underlying economic associations here, because if you look across these two time periods, you see a very big difference in the real estate loan relative to net charge-offs. But also, you can see in terms of this measure that we've come up with, that it is significantly higher during that post-crisis period, or the relative at least to the pre-crisis period. Of course.
On the previous slide, on your definition of unexpected losses, are we assuming that NPLs grow at the same pace as the total loans do? The ratio of NPLs to
So that's the expected portion.
the expected portions.
Okay, what we're trying to do is say use this unexpected portion and try to then assess.
Would it be reasonable to assume that during a crisis the NPL ratio itself would go up?
Oh yes, absolutely. Now remember, we're doing this each quarter. So we're just trying to look ahead one period given the information we had. Now you would expect if you had much more detail, and we can only do it with public disclosures, if you had more detail and we could partition this, and we do some of that in some other tests, you'd be able to actually get finer and finer measures of this particular calculation. Now the question, that's sort of just the setup. Let me tell you what we then do is say, okay, so we've got this measure now of expected rate of credit losses. How well does it actually predict the realized credit losses themselves in the next period? And so what we do is we take those calculations we've done and the estimates of the coefficients, and we actually calculate for each bank for each period what the expected rate of credit losses would be. And then we use it to try and predict in the future how well it actually did. So if you look at the results of that, and this is a subset of them, and you compare it to the actual last year's realized rate of credit losses or the net charge-offs of the prior period, what you find if you look at this is that our measure actually does much better. So if you look both in terms of its explanatory power and if you look at the sort of power of these coefficients, you'll see that it does better than the realized rate of credit losses itself and the net charge of itself on their own. And when you combine those measures, which are the public disclosed measures, with our measure, we in fact explain virtually all of it, especially for the realized rate of credit losses. So that's very comforting as a starting point. The question that you have to ask yourself, though, is, well, what about the allowance or the provision for loan losses themselves? How do we do relative to that? Aren't those good predictors because those are coming from management? So that's this next set of tests. And again, what you see here is this is our measure by itself. If you look in with the allowance does okay, not very well. The provision does much better, but when you include our measure as well as the allowance and the provision, this measure still does statistically better, and it's incremental to the other measures as well. So it's comfort again that this is something that could actually be quite useful. The next question that comes out of that is, well, how does that relate to actually the stock market and what the stock market's doing? And it turns out that if you could use this measure, it is associated with next period stock returns. So again, it suggests the market's not necessarily picking up this expected rate of credit losses in the way we've estimated. So it would actually be potentially useful for investors or analysts to actually think about making adjustments to this expected loss model that they've got as they're doing it themselves. So that's, again, just a set of quick results for it. Now, yeah, well.
How big was the sample of banks that you used, and how diverse were the banks?
My colleagues will know this better than I do, but it's around, if my memory serves me, we've got around, after we do all the adjustments, I think it's 600, or is it 370?
Well, the one in stock price is around 300.
Right.
So about 700.
What was for the other?
So they're all publicly held banks in the United States?
Correct. We were constrained by the call report data that actually was one of the main constraints. Also, one of the particular variables, I think it was the loan yield. There's some constraints on how much information is actually available for that.
And did you include banks that went under during this period as well? Like
yes. So the last sort of question I'm going to look at or talk about now, subject to questions, is many people believe that banks with their fair value calculations are going to incorporate the expected credit losses, and they have much better information clearly than we do. Actually, Professor Nissim, in his dissertation work many years ago, had shown that banks adjust their fair value measures somewhat subjectively as well. So we had some view that actually we'd probably do, that this might actually be more useful. And in fact, that's what these results essentially show, is that not only does our measure of expected rate of credit losses explain some of the fair value, or is associated with the fair value measure, but actually when you include the fair value and our measure in looking at next period's realized rate of credit losses, this measure still has very strong associations. So the bottom line of this is that we've used the public information we have, which looks at those things we would think would help us better adjust for any biases, any missing information in terms of what the companies are actually doing themselves, and we estimated essentially a measure of expected credit losses that is quite useful.